significantly raise costs over what the same product can be produced for in strictly domestic markets? Second, is there any current or pending tax legislation within your home country that could inhibit your foreign market operations? Once again, in most countries desiring to promote foreign market trade, you would expect tax laws to be favorable to the exporter. However, it is better to be aware of the tax ramifications of your international business activities before you embark on this route. Third, how reliable is the domestic distribution system within the host country? In order to participate in international markets, many companies, especially those in the interior of the country, must first arrange for domestic transfer of product to a border port. Does the transportation system you will be using have a reputation for reliable on-time delivery? Does your product have to pass through any other domestic entities before it is ready for export? How do these value-added activities impact your costs? Are there any pending bottlenecks in the distribution channel? For example, strikes or understaffed export customs or processing centers? Fourth, are there any factors in your own country's domestic economy that could adversely affect sales or costs? How would your company deal with these problems? Critical sources of supply needed to support foreign market operations usually include labor and raw materials. Here, you must evaluate the reliability of these key sources of supply and assess whether there are any pending changes that could have an impact on your costs and subsequent availability. Will any of these factors threaten your ability to export? Since you will be expected by your foreign partners or customers to promise reliable, on-time delivery, you in turn must be sure that you have made adequate arrangements to secure your own critical sources of supply in a reliable and cost-effective manner. Fifth, how reliable is your banking institution? In many cases, your foreign business operations will be conducted with the intermediary assistance of a domestic bank or other financial institution. Does your bank have the capability to work with foreign banks to ensure that funds flow freely from your foreign customers' accounts to your domestic accounts? Will your bank be willing to offer you sufficient credit lines to manage the cash flow gap between your own payments on product costs and revenues from your foreign customers? Sixth, if your product requires licensing, what is the possibility of a delay or inability to get the license? Sometimes the company doing business in international markets is doing so under the auspices of another company which has a proprietary position in the key product or service. Other times, your company may be dealing in the export of products or services that require special licensing arrangements with the government or other such entities. Have you worked out any adequate licensing arrangements with that company or other government entity which will ensure you're having access to sufficient supplies of your products when you need them? Do you anticipate any delays in obtaining such licenses? Seventh, what is the potential of technological breakthroughs that could render current products obsolete? Direct or indirect competitors in your domestic or international markets can potentially come up with product or service offerings that represent far superior value in terms of cost and performance than your existing product mix? Is this a current or potential problem in your industry? Is your foreign target market ready and willing to accept your products or services if better or more cost-effective alternatives are or become available? Now let's look at some international risks. First, are there any potential changes in your foreign target market's government regulations, protectionist legislation, for example, that could have an adverse effect on your costs or sales? Relations between governments are constantly shifting. Political or social events occur with increasing frequency that can impact your ability to do business in certain foreign markets. When entering a foreign market, you should consider the state of relations between the two governments and how such relations may impact your ability to do business. Will the foreign government impose tariffs or quotas on the import of your specific products or services? Do you expect to experience any unnecessarily long customs delays at the foreign market port of entry? Will you have to make any costly value-added adjustments to your product before it can be sold in the foreign market? Second, are there any factors in your foreign target market's economy that could adversely affect sales or costs? Have you priced your product appropriately in the market? Clearly, when contemplating international expansion, your company's management team needs to learn as much as possible about economic and business conditions within your foreign target market. Can people afford to buy your product or service offering? Pricing is always a difficult issue, even in a domestic market context. The challenges and complexities can only multiply when attempting to price a product or service in a foreign market. Your company also runs a greater risk in that it is much more difficult to change a price in a foreign market than it is domestically. If economic conditions change or your target audience is not receptive to your pricing structure, then it will be difficult to establish a viable foreign market position. Third, if you are applying for an international patent, what would be the effect if you failed to get one? In some instances, your company may have established a proprietary position in the products or services you desire to export. Clearly, having patent protection in your home market may not be sufficient to protect your interests abroad. If your products truly are proprietary, then you may want to seek the legal advice to extend your protection to international markets as well. Also, you must evaluate whether or not you have the resources to defend your patents even when they are violated. Fourth, what is the possibility of customers from your foreign target market not accepting your product because of cultural differences? What could the company do to change this situation? Understanding cultural differences is an important part of successfully establishing a long-term presence in foreign markets. Cultural differences affect the manner in which business is conducted in various market settings, as well as how your products and services are perceived in your foreign target market. In the first instance, it is important to understand how cultural differences can impact how business transactions are negotiated and consummated. For example, in some countries, a formal written contract is usually required to formalize a business deal, while in other cultural settings, a handshake or a word is what gets the deal done. In the second instance, you need to be concerned with how your product is designed, packaged, and marketed in various cultural settings. A classic example of this situation was when the Gerber baby food company tried to market its well-known product line in certain African nations. In one cultural setting, the target market group was used to food labels on product containers that have a picture representing the food in the jar. You can imagine the reception Gerber received in that market when it used its renowned Gerber baby picture on the label. Fifth, are there any barriers to entry that could affect the success of the product or service and what the fallback plan is? How difficult will it be to enter your specific foreign target market? Are there any barriers such as tariffs, quotas, or union activities designed to protect domestic competitors? In developing a plan to enter a foreign market, it is critical to understand the ramifications of this issue. Barriers can impact the cost of your product in foreign markets, which might be totally different from your cost structure in your home market, and they can impact your ability to respond in a timely manner to customer demands. Sixth, is there a developed or developing banking and financial system within your foreign target market? Is there a possibility of currency risk? How would an unstable financial system affect your operations? Before entering foreign markets, especially in underdeveloped countries, it is important to assess the country's financial infrastructure and the financial stability of its currency. You want to make sure that foreign customers have the capacity to gain access to the funds required to conduct business with your firm. Are they able to obtain letters of credit, and are they able to work with financial institutions that can interface with your own domestic institutions? Also, it is important to evaluate the stability of that nation's currency relative to your own domestic monetary units. Remember that in situations where your currency is considered to be strong relative to that of your foreign target country, customers in that country will have to come up with more units of their own currency in order to purchase your goods and services. If your monetary unit's currency is too strong relative to that of the foreign target country, you run the risk of having your products and services effectively priced out of the market. Also, sudden changes in the relevant exchange rates after you have consummated a deal may negatively impact the amount of your own currency you can ultimately collect. 7. Is there a developed or developing transportation and distribution infrastructure within your foreign target market? If not, how does this affect your operations? Transportation and communication systems vary significantly between nations, especially in situations where you are seeking to do business in lesser developed nations. Do you need to be concerned about the safety and viability of the roads your products must travel on while within your foreign target country's borders? If you have to use domestic and in many cases unionized labor to transport your goods and services, You need to consider whether or not they are trustworthy and capable of properly handling your products. I now finally want to turn our attention to the challenges and risks you may expect to encounter when using foreign partners in some form of a strategic alliance. Those foreign partners often represent the marketing and distribution arms of your company. In many instances, they can assist you in dealing with the maze of government and cultural issues within your foreign target country. When executed properly and with a compatible partner, strategic alliances can represent the safest and surest way to enter a foreign market. Your key concern is to find and structure a good deal with the right foreign partners. However, even in situations that look quite promising, there are many challenges and risks that could impact your ability to function in that market. Therefore, in planning for a joint venture arrangement, you should consider, among other issues, the following key challenges and risks. First, how do cultural differences impact the joint venture relationship? It is safe to assume that your foreign joint venture partners will function with a different set of rules and nuances. The key is to whether or not you and your joint venture partner can operate effectively given your cultural differences. Such issues may revolve around attitudes towards time, where your firm may be very focused on business and doing the deal, while your foreign partner may operate with a no-hurry attitude. Attitudes towards work and motivation of employees. For example, you may be used to closely supervising workers, while your partner may take a very unstructured and hands-off approach. And attitudes towards dealing with key customers, where you may be very customer service driven and oriented, while your foreign partner representing you in this market may not have time or is not oriented to being highly responsive to customer needs. Second, do you and your strategic alliance partner share common objectives? You may have developed a strategy based on establishing a long-term position in the market. As such, you may be willing to make the kinds of decisions that may compromise short-term profits for the sake of building for the long haul. Your partner, to the contrary, may be oriented towards gaining quick strike deals that may be profitable in the short run but do nothing to build long-term relationships. Third, how compatible are the decision-making processes between alliance partners? Decision-making processes can tend to vary greatly in different cultural environments. The classic example is the typical American firm, on one hand, whose managers tend to reach decisions quickly and then are much slower to implement, preferring instead to work out the details later. On the other hand, a typical Japanese firm takes a much longer time to make a decision, preferring to build a consensus among all affected parties. But once a decision is made, implementation happens very quickly. Fourth, what are the various attitudes concerning contracts? As I discussed earlier, cultural differences play a huge role in how firms from different countries conduct business. What constitutes a contract and a deal to work together in one setting may be very different from what works in another environment. Fifth, will differing management systems impact your ability to do business? As I also mentioned earlier, different attitudes, styles, and approaches toward work could significantly impact the strategic alliance relationship as well. How your company's management team thinks about, addresses, and overcomes these issues will significantly impact your ability to compete in foreign markets. Clearly, in planning to enter foreign markets, one cannot think about and account for every possible risk and threat that could impact your business. The objective here was to provide you with a framework in order to assist you in identifying and evaluating the most obvious risks that could impede your progress to firmly entrench yourself in foreign markets. Based on these internal and external risks, the entrepreneur should include contingency plans that will assist both the company and any possible investors in evaluating the viability of committing to the establishment of an international presence. When developing contingency plans, you need to consider probability assessments to these risks. Thus, most of your attention can be paid to developing alternative strategies for the most serious of risks. Another way to attempt to mitigate risks of international expansion is through selected types of business insurance. Obviously, business insurance can be quite expensive and must be carefully designed to meet the specific needs of your business. There are many types of business risks, however, that can be covered through adequate insurance provisions. Several essential coverages include fire, liability, property, key person, and shipping. Other desirable coverages include business interruption, theft, and rent. A third category, employee benefit coverages, includes group life and health insurance, disability, and retirement. The following questions will assist you in evaluating your insurance needs. Following my talk, Mr. Michael Jordan, an international business insurance specialist, will expand greatly on these critical issues. First, have you made provisions in your financial projections to cover costs associated with essential insurance, such as general liability, fire, or auto? What are the estimated costs for each type of coverage? In evaluating the different types of insurance coverages, you want to be sure that you have accounted for these costs in your financial projections and modeling. Many times, entrepreneurs fail to take these added costs into account when determining whether a foreign business deal makes sense. And lastly, what types of insurance will be in effect at the time you commence international operations? It is important to make sure that the most essential coverages are in effect when you start doing business internationally. Typically, international coverages include foreign shipping and handling and foreign product liability. I hope that you have found this talk useful in raising risk-related issues in international business. My colleague will now discuss with you some approaches to mitigating some of the risks we have just talked about. Thank you for your time and consideration.
Thank you, Dr. DeNoble. Let's begin the first question and answer session. We will try to answer as many questions as possible. Therefore, we ask that only one question be asked per phone call, and that these questions be as brief as possible. You may call the studio directly at the phone numbers or fax which now appear on your screen. We remind you to make your phone calls at a distance from the monitor to avoid feedback. Our first question is from KTV Comunicações in Rio de Janeiro, Brazil.
Buenas tardes. Good afternoon. The ITC's video conference series, World-Class Principles for World-Class Development, World-Class Performance, it has opened our eyes about the importance of considering the differences between the different countries, especially the cultural differences and the economic differences. However, the problem is that globalization is generating habits and tastes that are very similar, becoming very, very similar. We know that we have McDonald's, Pizza Huts, and other kinds of enterprises of this type. And how can businesses protect themselves from that very strong influence?
Dr. DeNoble, would you like to address that?
Well, I think the gentleman brings out some important issues. The world is getting smaller in that regard, where international companies of the size and magnitude of a McDonald's is pervasive throughout the world. And people throughout the world are used to that kind of a product. In those situations, it creates some unique opportunities for firms to try to capitalize on large economies of scale, not only in the types of products that you're able to produce, but also in the brand name and the image. And I do think that that is an important issue and an important trend to consider, but for most companies that are embarking in international markets to begin with, I think you're still going to be confronted with a lot of these major cultural differences.
Mr. Jordan?
I really have nothing to add to what Mr. DeNoble has said. I think that it is a reality. The global community through communications such as this network is something which does bring together different communities, and the exchange of products and cultural values is something which will lead to normalization between these communities. And nonetheless, I think that the unique cultural values of the ethnic quality of a given community will not be dissipated. There will be always, I believe, a market for the core the core group of local industry.
Thank you. Our next question is from La Universidad de los Andes in Santa Fe de Bogotá, Colombia.
On behalf of all the participants of our second meeting for the group of 3, Mexico, Venezuela, and Colombia, we would like to greet all of our Latin American friends. Our question is the following. One of the current tendencies that is a product of the globalization of the economies is the need to flatten the structures of the organizations. What is the limit? What would you say would be the best way to create an international association that is effective?
Dr. DeNoble, did you hear that question?
Yes, I did. With regard to flattening of structures, again, I think that that is an important trend in business organization design in general, let alone in an international context. I think the major drivers that are leading to flatter organizations are the increased use of telecommunications and information processing technologies. The more pervasive these technologies become, the more it enables organizations to function and operate with flatter